So good morning, and I'd like to welcome you to MaRS. MaRS is Canada's largest innovation hub and is focused upon building the next generation of technology companies. The title of this morning's event is Ontario's Bioenergy and Biochemical Innovators, Carving Out a Space in the Emerging Bio-Based Economy. This event is the outcome of the Digging into Bio-Based Innovation Market Insight paper that was released today. You can see the postcards on your table. On the back there's a QR code if you'd like to download it. Otherwise, you can download it from the website. I hope you are as excited as I am about today's topic. I will provide you with some context for today's event. My name is Linda O'Malley, and I work with the MaRS Market Intelligence team. I provide cleantech and advanced material and manufacturing startups with market research services. The Market Intelligence team receives requests from all 17 of Ontario's regional innovation centres as part of the Business Accelerator program. Over the course of this year, I have been seeing an increasing number of startups in the bioenergy and bioproduct space coming in from the various regional innovation centres. I wrote this paper to give focus to the sector in Ontario, to better understand the opportunities for the market players in the bioenergy and bioproduct space. This is an important portion of the $87 million bioeconomy that is emerging across Canada. Rich in agricultural and forestry resources and possessing the largest food processing centre in Canada, Ontario has an opportunity to resolve waste issues and become a leader in feedstock supply and end-use applications, such as biofuels, biopower, and biochemicals. I'm going to turn the discussion over to our panelists, who can shed more light on today's topic. I want to thank the panelists for coming out and being part of this event and sharing your insights. So let's all give them a round of applause. And let me introduce our moderator. Tom Rand is a venture capitalist, author, advisor, and currently acts as both the managing partner at the MaRS Cleantech Fund, as well as a senior cleantech advisor here with the MaRS Cleantech Practice. Tom, over to you.
Thanks, Linda. Welcome, everybody. Thanks for coming out so early on a whatever day it is today. What day is it today? Wednesday morning. I had a chance to read over this report last night, and I highly recommend that you get a copy of it. It's got a fair amount of insight, and I think what it really does well is characterize the ways in which, of course, the bioeconomy is different from other pieces, right? Here at MaRS, we have a clean tech sector and an IT sector and a life sciences sector, and they all have their own kind of ecosystem. And I've said for a while, one of the challenges clean tech faces is that it's big wires, not little wires, right? There's a very different relationship between technology and the deployment of that technology. You typically get involved in project finance. It's big infrastructure. So as a venture capitalist, there's gaps to fill that are very different from the IT sector. And I think biofuels probably exemplifies that distinction more than almost any other sector, even solar or wind or so on. I mean, in solar and wind and smart grid, there's always components that you can play with, and you can sort of insert pieces. But often, it's the case that in the bioproducts industry, it's a system, right? And the system as a whole needs to function before you've got any output. And the scale of that system is often very big, right? And I think we have some panelists here that are dealing with exactly that issue today. Some have gotten over that chasm, and some are looking to get over that chasm. And so in the report, for example, they talk a lot about feedstock issues. So it's one thing to scale your technology up. It's then another to be able to tell an investor or a private equity group how big can your company get and what are your feedstock constraints going to be. And it's very difficult to see that because you can say, well, for a while, the first 20 million gallon plant doesn't really matter. Well, what will be the effect of your demand on the feedstock? Well, I don't know because there's other people entering that space as well, right? The classic would be, somebody thought I can turn all that vegetable oil into biodiesel. What a great business. And then all of a sudden, as soon as you're feeding more than 3 vans, you're competing for that. That same problem on a larger scale exists on the feedstock side. And of course, that affects finance because once you start gobbling up a lot of feedstock, you're a big plant, not a little plant. And that's often the only way in which this stuff works is at scale. So we have lots of companies at MaRS that are getting through that problem immediately. STTC is there to finance a little bit of it. But again, these are big wires, not little wires, infrastructure, not technology. So this report, I think, brings out a lot of those differences in some detail with some statistics and some references. So I highly recommend you take a look at that. One of the other pieces, of course, market drivers. Not all parts of the bioeconomy require policy drivers, but many do, right? The ethanol industry, for example, is regulated. And even if you make a case that I can produce ethanol for less than gasoline, you still have to be able to finance that plant. And you've had VCs back out of the space almost entirely because this is infrastructure. And VCs got burned on this back in 2008, 2009, 2006, and so on. So there are a number of sort of challenges this industry faces that are unique to this industry that I think exemplify the larger picture for clean tech as a whole. And so Linda's done a great job, and I think it's a really good report, in bringing out some of that data and putting some quantitative analysis onto it. So we're going to bring some of these issues to life with the panel today. You're not here to hear me, you're here to hear these folks. This is a tweeting crowd. I can't really tell what's a tweeting crowd or not, but if you are a tweeting crowd, bioinnovation is the hashtag that you should be using. So I'm going to introduce our panel. We have one who's a little bit late, so we'll just talk slowly and wait for him to arrive. But in the meantime, we'll have a good discussion. So we do have Bob Gallant, the president and CEO of Greenfield Ethanol. We have Scott Thurlow, the president of the Canadian Renewable Fuels Association. We have Andy Heintzman, CEO and founder of Investeco, a fellow investor. And who will be arriving is Garry Rawson, who's the VP of Finance and Corporate Development at Elementa Group. So I'll turn it over, but just before I do, in terms of visualizing this crowd knows something about this, so I don't have to paint too detailed a picture. Take biomass, whether it's cellulosic, next generation non-food stuff, or food, process it in some way, which is where the technology piece comes in. That could be as simple as pack it into a pellet, or it could be as complicated as gasify it and then recatalyze it into some other form. Right? So that's where the processing comes in, and out comes a product. And that product could be heat or electricity at the very simplest. It could be biopharmaceutical. It could be a commodity for an input into an industrial process, ecosynthetics and so on. Or it could be a fuel. It could be a liquid fuel. So that entire range of applications is what we're talking about today, right? Right the way from different sources of biomass, many different kinds of processing, torrefaction, gasification, what have you, many different kinds of outputs. So it's a very broad view of the bioeconomy that we're talking about today, and we do have examples of many of these different kinds of pieces, right? Different biomass, different process, different output. And they come together in very complicated ways, but we'll try to bring some life to that for you this morning. So why don't we start with you, Andy, and take your time and talk from there or come up to here, whatever you want to do.
Is that all right?
That's absolutely fine.
Feels like sort of an informal, could be an informal setting, so I thought I'd play on that. So everyone can hear me? Thanks, Tom. As Tom has said, we're co-investors with the MaRS Cleantech Fund in at least one company, Woodland Biofuels, which fits this morning's discussion. And we are a Toronto-based VC focused on expansion stage companies in environmental and sustainably oriented sectors, of which the bioeconomy would definitely be one that we look at. We've raised about $50 million. We have about 100 investors, mostly high net worth investors, and we've invested in 14 businesses, and a couple of them, probably 3, depending on how you define this sector, would loosely fit into this sector. So I thought maybe what I could do is just sort of take some of the things that I've seen from being an investor in this sector and maybe apply them to this morning's topic. But before I start, I thought I really need to kind of manage expectations. Especially, I'm not a chemical engineer. In fact, in a way, I'm the furthest thing possible from a chemical engineer. I did a master's degree in English literature, studied Wallace Stevens and poetry. So I'm not going to address the kind of technical challenges. But what I think I can maybe address is some of the business challenges. And what I hope to do is kind of make 4 modest observations about the kind of factors for success in the companies that I've seen, and then kind of another 4 observations or considerations for investors in the space. And hopefully that will be interesting. So the 4 factors for success that I wanted to touch on that I've thought. These are kind of outside of the 2 obvious ones, which is really technology, which I said I don't want to address directly, and I guess feedstock availability, which is, I'm going to leave those aside. They're sort of in a way, I think they're the obvious ones, and I'm guessing they're going to be addressed by other speakers. But I wanted to talk about 4 others, and those are partnerships, capital cost, capital structure, and management teams. So let me start with those, and then I'll also talk about kind of 4 ideas for investors. So let me start with partnerships. So one of the companies that we are an investor in is a company called Ensign Technologies based out of Renfrew. And I sort of want to put them out there as a real poster child for effective partnerships. And I thought maybe it would be useful if I just went through that. Though they've done a tremendous job of lining up partnerships, and they've really built their business around partnerships. So let me just take you through this. I'm guessing most people here know Ensign. It's a company based that uses a fast pyrolysis to convert biomass into a number of outputs, but transportation fuels is sort of the biggest market. They started quite a long time ago in the 1980s, and they made a partnership with a company called Red Arrow, which they provided chemicals for food ingredients. And they actually built a number of plants. I think by now they've built 6 plants with Red Arrow. And that was their first partnership, and it supplied them revenues and capital, and it also allowed them to deploy their technology and demonstrate its usefulness. They did a second partnership with a company called Ivanhoe for heavy oil upgrading in 2005. That was a very effective partnership. It actually delivered them significant capital, and they basically licensed their technology off for that vertical. Then they did another partnership in around 2006, 2007 with Honeywell UOP, which, as you probably know, is the leading international supplier and licensor for petroleum refining, gas processing, and petrochemical production. So it's a hugely valuable alliance. They actually created a co-owned company called Envergent. So they've worked very closely with Honeywell, and Honeywell UOP brings huge credibility. Then they did a partnership with Chevron. We're actually, in our series of investment was made with Chevron. Chevron's been a close supporter of the company, investor in the company, and partner in the company. More recently, in about 3 years ago, they took an investment and made a partnership with Fibria, the world's leading supplier of wood pulp out of Brazil. They made a joint venture for a Brazilian joint venture with Fibria. They did another partnership about 12 months ago with Renova Capital Partners, a private equity firm, and they actually brought a partner of Renova in to be the CFO. They have a partnership with Credit Suisse, leading investment bank, and then they also have a partnership with Pinova Holdings, leading supplier of specialty chemicals, and that's a joint venture around chemicals. So, an amazing array of partnerships, and this company's really propelled themselves based on those partnerships, and they've also done it in such a way to sort of dramatically reduce the capital costs. So it kind of leads to my second point. If you do partnerships well, you can reduce your capital requirement and equity capital requirement, and so that to me is sort of the second real challenge these companies face. So we were approached by a firm. I won't say the name or even where they're from, but this is about 2 or 3 years ago, a biofuels company, and it sounded really interesting. And one of my first questions, well, how much will your first plant cost? And they said, well, $1.5 billion. So, and that, you get that fairly often. And what we've seen is a lot of companies that have failed because of the capital requirements. I don't know all the insides and outsides, but it would appear to me that Iogen has struggled for that reason. We can see Kior struggling for that reason. In the public markets, their information is public. They're obviously struggling, and there's a clear link between capital costs and feedstock cost and availability. As your capital costs go up, you're typically requiring more and more feedstock, harder to locate your plants. All sorts of other complications come into play. So this sort of back to point number one: if you can have partnerships that actually help to supply capital, you can reduce your capital costs, and you can be more efficient in the market. The third point I was going to make is sort of a raising capital point, and it's a point about going public. So what I think you've seen in this space is a lot of companies have gone public too soon. And just one interesting example is Dynamotive versus Ensign. Dynamotive was also a fast pyrolysis company that went public a long time ago, and I think they've pretty much disappeared. I don't know if they're around anymore. And I think at least part of that was due to the fact that they went public too soon. Kior obviously went public, I don't know, it's something like $2 billion, and today maybe has a market cap of 200 million, and all of their mistakes they make in front of the whole world. It's a tough way to do business. We had a company called Bioenergy that went public too soon in our portfolio, a company that has biofiltration equipment. And really what I learned is don't go public until you are profitable, basically, or until, if you have to raise money again, in the public market's a great place to raise money when you're profitable, terrible place to raise money when you're not profitable. So you have to be close enough to cash flow positive. And then the next point was management teams that I wanted to talk about. So this is a space that requires depth of management teams that I think is truly more challenging than many other sectors. You know, you sort of have to be good at everything. You need excellent finance. You need fantastic engineering and technical skills, project and plant management, legal. You need, once you have all that, you need to have human resources, strong executive skills. It's got to be a full team, and so there's a real need to build powerful teams, and it's one thing we've seen positively happen at Woodland Biofuels. The addition of Bill White, former president of DuPont Canada, helped to really flesh out that team. But that's a hard thing to do, and it's a hard thing, especially it adds requirement to raise capital, and it's just another challenge for companies. Then those are my four sort of thoughts on considerations for companies. So just quickly wanted to just leave sort of four ideas for investors. One is one of the things that we've struggled with a bit is the size of addressable market. So that's one of the challenges, I think. I would sort of point to Bioenergy as an example here, where the biofiltration market looks very large, but what turned out to be the case was the addressable market was not as big as we thought it was. And Bioenergy, incidentally, is actually doing reasonably well now, but it's taken them a lot longer to get there than we thought it would. Structure investment is critical. If you can have, this is a space where, as an investor, you'd like to have preferred share deals, down round protections, ratchets, liquidity preferences, all those kinds of things. Why? Because there tends to be a lot of follow-on investments. So you have to reserve capital for follow-on. You have to expect that there will be multiple rounds. And then the last point I'd make is it's a space, though, where there's some interesting smaller niche plays. Some of the big biofuel projects get a lot of the attention, but there's actually some interesting smaller plays, and there's a few that we've been interested in. For example, a company called Ormi, which I thought was a really neat little business that collects the fats, oils, and grease for biodigesters. It was a small public company. It ended up being bought by the Walker brothers, but a neat little business. And it just sort of had a nice little niche, and it was a good profitable business. Or another business like Zeton, for example, a private company that actually builds the plants. So I think there are kind of cool niche plays that you can look at as an investor in the space as well that are sort of less obvious. So those are my thoughts, and I'd be pleased to talk more about them later.
Sure. Just before we move on, actually, I want to push back a little bit on one of the points that you made, where you talked about the timing of going to public markets. Obviously, there's macroeconomic conditions that need to be right and all the rest of it. But I would argue that someone like a Kior, who's gone to the public markets and fallen a bit on their face, I mean, it looks like they're picking themselves back up again. They didn't have a pilot plant, for example. Kior went very quickly into a large-scale engineering and faced scale-up problems. So we know how hard it is to find capital for these companies, right? I mean, there's very few VCs playing. So if you need to raise $50 million to build your first commercial plant, I would argue that to get there, you simply need to bring reasonable engineering data from a pilot plant, sufficient so the engineers can have some confidence it'll move forward and can scale up. I mean, it's tricky, right? I mean, yes, it would be nice not to go to the public markets until you're profitable, but if you're raising $100 million and the VCs are out.
Yeah. No, right?
I
actually don't think I think of it this way. You can go to you have to raise capital any way you can raise capital. If the way that you have built is public markets, then you raise it in the public markets. But And I think you can raise money in the public markets before you're profitable. But if you have to raise a gain, that's when you get killed.
Right? Yeah, I think that's a very good point, as Kior has learned the
it's
hard
the
way.
Second raise. It's not
It's
the one.
second raise. That's a very good point. Good. Great. So we'll pick up on some of that again later. There's a lot of threads in there. Thanks, Andy. Bob, why don't we go next to you and hear your story?
My pleasure.
Do you want to go? You're welcome to go to the stand or stay here. It's up to you.
At 5'7", I avoid podiums. Okay, so, but I do need the clicker, so I'll just get
Shall I slouch in my chair?
Thank you. Bless you. I may be at the wrong session. You tell me when I'm done. You should look at us more as the boring innovators. We do our innovation on what I'll call a microburst basis. And I want to talk to you about how we got to that conclusion and what disciplines we use to maintain that and continue our growth in very innovative areas. But first, there's the prerequisite company ad. So who are we? I guess rule number one, we're billed here as Greenfield Ethanol. We've recently changed our names to Greenfield Specialty Alcohols, Inc. So rule number one is don't become enamored with who you were. Work on how you attract attention on where you're going. For those of you who are familiar with it, basically fuel ethanol is just another form of alcohol. This company has been in the alcohol production business since 1989. We've been quite successful. When I joined the company in 2000, we had a podunky little plant in Tiverton, Ontario. We had just built a plant in Chatham, Ontario, which was schizophrenic. It made both industrial and fuel ethanol, we thought. We were making maybe $19 million of EBITDA. Today, we have over 400 employees, union-free, 6 plants in North America, about $600 million in sales, and we're snuggling up against about $100 million of EBITDA a year. So the story has worked. It's just not terribly sexy. So briefly, who we are is we're what we call a Great Lakes Basin company. We're a Canadian company. We're a privately held company. But we decided strategically way at the outset that rather than try and stretch our wings and cover Canada because it felt good, we really had to do what made good commercial sense. So in our case, the Great Lakes Basin is the zone that works for us, where we can get our resources where we need them quickly, et cetera, and we understand the market. The pie charts on the right, and I'll be much quicker than this on the next slides here, give you an indication of how our business breaks down. And where I'd like to take you to is that last pie chart at the bottom. It gives you an idea of the gross profit contribution roughly from different segments we're in. So you see 3 pieces there: bulk alcohol, packaged alcohol, which basically are the same thing. Packaged alcohol is just bulk alcohol moved up the value chain, higher value packaging, et cetera, very specialized product. And then fuel ethanol. We were known as a fuel ethanol company, and we did that intentionally in our growth phase for the macro growth period. But that represents, excluding government incentives, which are falling off, which was part of the original plan, that represents only about 25% of who we are. And that lesson was important for us. So again, very quickly, don't try and read the bits and pieces, and I think this material is available later if you want it. But you look at our business as we make bulk industrial alcohol primarily. That means that probably today, as early as it is, you've used our product 5 or 6 times. When you brush your teeth, you use mouthwash, you use aftershave, most cosmetics, et cetera, all contain the alcohol molecule. Hairspray, for example, in the old days was a huge user. If you used a Purell when you came into this room here, that's our product. So we have roughly 5,000 clients in that business, in industrial alcohol. That was our platform. We moved it up the value chain by making very specialized pharmaceutical alcohol in the packaged area. I'll give you a brief example of that. We provide very certified product into the pharmaceutical area. We produce a gamma irradiated alcohol that's the highest purity available on the planet. It's triple packaged and bundled with water for injection and sold to very specialized hospitals for treatment. There's an example of one extreme for that molecule. The other end is fuel ethanol. That's a crude product. Not that it's easy to make, but it's a somewhat different process. And then finally, the agricultural piece. When you take a bushel of corn, in our case, because we're a Generation 1 today, fuel ethanol company, a third of it becomes ethanol. A third of it becomes CO2, which we sell to firms like Praxair and Air Liquide, et cetera, for everything from carbonating drinks to welding rod fabrication. And then a third becomes dried distillers grains. And dried distillers grains is basically an animal feed that goes back to the farm from which we drew the corn. So we like to say we just borrow the corn, remove the carbohydrates, and return the high protein, high value feed back to the farm. Oil industry doesn't quite buy that pitch, but that's our story. And the reason it's important is when we decided, literally sitting as a small industrial alcohol company in Tiverton, Ontario, that we needed to grow. We knew the industrial alcohol business, but we didn't have the capability to do it. We were fortunate that the world decided that it was interested in something called fuel ethanol at that time. That allowed us to attract government incentive programs that may be controversial, but there's a way to deal with those that we think we've got our arms around pretty well. And the other aspect of fuel ethanol that was an issue for us was it's a commodity type of business. You're bringing in an agricultural product, an agricultural commodity, and you're selling into a petroleum-based matrix. That's fine when corn is cheap and gasoline is high. When it goes the other way, you can literally go cash negative overnight. So we had to learn how to do hedging very effectively. All of that taught us that as we grew our fuel ethanol business, we had to grow our industrial business. And there, I think, is the major lesson for us. The decision to get into fuel ethanol, where we spent $450 million in building 2 world-scale fuel ethanol plants, one in Quebec and one in Ontario, that are pure-play fuel ethanol plants. That was a goal. We knew we could make money in fuel ethanol. But the other objective was that was also a way to get our hands on $450 million worth of assets that we could then evolve into what we believe the industry as a bio-based industry could do. And some examples of that, this is just, the last talk I gave on this, and some of you may be aware of it, was for refinancing our old debt. So bankers love to hear that you're a boring innovator. The more boring you are, the better a banker likes you. Investors, maybe not so much. As a private company, I'm not overly concerned about that. So we were showing sort of the conservative approach we've taken to incremental growth. And we use such things internally as root cause analysis in a very disciplined way, stage gating all of our programs in a very disciplined way. I have 25 years of experience of stage gating in the chemical industry in the US primarily. So you implement those disciplines, and you end up leveraging your decision of going into fuel ethanol into a larger objective, which is to create biorefineries and to understand the value chain associated with each one of those well enough that you can find the weak spot. Now, I'm going to run out of time here, but what I want to do, there's a few examples here of the kinds of technologies, therefore, that we're involved in. All right, anaerobic digestion. We're building an anaerobic digestion facility to use the municipal waste from the city of Montreal and 22 other communities in the Varennes, Quebec area to produce methane to displace natural gas at our Quebec facility, because natural gas in Quebec is significantly more expensive than it is here. Greenhouse operations. Our Chatham facility, there is now the first quarter of a 90-acre greenhouse under one roof across the street from our Chatham facility in Ontario. We sell them our CO2 and our low-grade waste heat. That's a biorefining concept as far as we're concerned. We're involved in thermochemical ethanol through a joint venture with Enerchem. Lignocellulosic ethanol, cellulosic ethanol, I heard the other day, is the fuel of the future and always will be. We believe that eventually it will happen. We focused very clearly on one aspect of that, which is the pre-treatment portion, which we thought we could do well and didn't kid ourselves into thinking we could deliver the whole package. That's not who we are. There's a few more here. What I want to get to is the last few slides. This is basically just a flow chart for a typical ethanol plant, whether it's Canada or the US or anywhere. And those are the steps, and you don't have to know them well. But what I want you to understand is once we determined that what we were getting here was a set of assets that would allow us to do more than just what the original intent might have been to produce fuel ethanol, it allowed us to get involved in a number of things that fit our risk profile. In other words, they were fairly large bets, but they weren't company-killing bets. And it allowed us to explore technologies that in the past we could not have because we didn't have the critical mass to do it. The other lesson we learned is we should take pride as folks that believe in technological success, but understand that they can also be a commercial failure pretty quickly. The willingness to be first to be second is really important for organizations like ours. To try and be the first one out there with a new technology may be exciting, but it may be the worst commercial move you could ever make. A number of the technologies we're putting in, we've let our confrères in the US lead it. We've let them be the point man. What we've done is tried to understand the value chain that has to fit into and where the weakness is in that value chain. I'm out of time here, but I think the best example we have here is coming back to Canada, and Scott knows this well, and I warned him I'd talk about this. When Greenfield, as a private company, decided that it needed to borrow $450 million to build the plants, right? We needed a number of things, including a way to make the banks comfortable with the concept and a way to entice investors. We were successful in getting long-term take-or-pay contracts. By long-term, I mean 10, 12 years from the oil industry, and take-or-pay means just that. They take it or they pay for it. And the way we did that was by getting the federal government in particular to put a mandate in Canada. Now, the US did the same thing. We watched what happened there. Their story isn't quite what you would like it to be. What we did in Canada, having seen the way it went for them, is we were successful in getting that mandate put in place through the Ministry of the Environment. Why does that matter? Non-compliance by an oil company in Canada for the use of ethanol, therefore becomes a criminal offense, not just a tort offense. It's not a fine and a slap on the wrist. Not too many oil firm executives would want their annual statement to include a comment that they were involved in a criminal act. So their instructions to their folks that work the supply chain make damn sure that we've got a domestic supply that's reliable and lock it up. That's us, right? That's a great non-tariff barrier, if you like, to other participants. That's just an example, if you like, of not just being satisfied that you've chosen a technology to produce ethanol that works, but that you understand what really works in the chain. Now, we were able to take those contracts to the banks. They were assignable. They liked them because even if we went belly up, they've got something there that has value. And we put together a syndicate of some 22 banks. It's like herding cats, but nonetheless, we had pure debt and we had private equity, and we were able to move forward. What that means today is we have 3 major plants: Varennes, Quebec, Johnstown, Ontario, and Chatham, Ontario. The yellow here is what those plants look like today. And here's where these plants are going. The blue are basically what I'll call microburst innovation programs. If I go this way, did I take it back? That apply to each facility. And the point is that even if 1 or 2 of these don't work, we haven't killed ourselves. But these are important startups. You know, the Enerchem joint venture on this facility. Corn oil separation, a lot of people are doing that. We watched the US do it. We've taken it a step further. We may get into biodiesel. We may get into a technology out of Israel that allows us to produce a family of esters from that corn oil. If we take our Johnstown facility, which is the largest single pure play fuel ethanol plant in Canada, same basic breakdown, and where we're going with that. We've got food grade fractionation. We believe there's a portion of the DDGs, we know, that we can extract and turn into a very high value food. One example is a corn butter that we have produced that I defy you to distinguish from peanut butter without the allergens issue. So school commissions, hospitals are all really interested in being able to do that. It's a fun project. If it doesn't work, it doesn't kill us, but it's pretty darn exciting. All right, and then corn oil separation, again, we repeated our facilities, things that well, biohydrogen, some algae work we're doing. They're all not quite skunk works, and I firmly agree with what was said earlier. You know, the lab level is neat. Pilot level is important. I got to tell you, to attract real money, you've got to go to a demo plant and then a commercial plant. That demo plant is critical because scale up is what will kill you, absolutely kill you if you don't have your arms around it. And that's where we spend a lot of our time. So we're kind of slow, but we're lucky in what we do. Same thing in our Chatham plant, a selective grind process that breaks down that corn kernel, the better use of CO2s, truly green greenhouse I mentioned to you. There's a lot of future in that in a biorefinery platform around facilities. Keep in mind, there are 200 plus fuel ethanol plants in the US with a vintage of less than 15 years. That's relatively new assets that are looking for technologies to bolt on. We're happy to sell, if we're successful, IP as well as the actual build-out. Our industrial expansion, I can't talk too much about that because we're right in the throes of it, but look at it as that's the way we keep that platform balanced for ourselves. And then, that's sort of our story. As I said, we're boring innovators. We choose our innovation ideas on the basis of, can we handle them? Do they make sense? Do we understand the value chain that they go into? And have we identified where the weak links are? And if so, what can we do about them? And that's about it.
That's a great story. And you're in a building where people are in startup mode, right? Beg, borrow, and steal your way to your first pilot plant. So when you say you have $100 million in EBITDA, that's a sexy story. When you say it wasn't sexy. So I would correct you on that. I might want to make a quick point. I'm really interested in your model for incorporating other kinds of technologies into your existing processes or as an addition or an addendum on your existing processes. For a couple of reasons. One, I want to know how you pick those technologies and what some of those considerations are from a business and a technical perspective. And obviously that's a big topic, but maybe give some highlights. And I think what's really interesting, and the reason I asked that question is that when there's a range fuels out there, when it falls on their face, it's bad for everybody, right? That the entire industry has to swim upstream to raise capital from the big guys because they point to that and say, and you say, well, I'm different from them, and here's the ways in which I'm different, and QED, I am not them. That's a hard argument to make because you have to have the time to make that argument, and they may write off the whole sector. So what I'm really intrigued by is your engagement with these other next generation technologies, whether it's lignocellulose or whatever, wrapping your arms around it in a way that doesn't kill you, but there's some benefit to the industry as a whole because every success story helps the industry. Right. So I want to hear a little more about how you make those decisions around what technologies you wrap your arms around, and almost how you talk about them, right? So they're not quite skunk works, but they're not quite public. So how do you manage that as well in terms of expectations, in terms of bringing your skills and capital to the table for a successful tech project?
I think, happy to. I think, and I haven't quite thought of it that way, but one of the distinctions, as silly as it may sound, is, if you took the demographics at our senior level, they're significantly older. In other words, there's a lot of experience there, people that have been burned in the past trying from start. So what that does is it forces a discipline in the way that we look at things. And something as simple as what's called stage gating, go, no-go programs on projects. In other words, you identify a set of milestones that is rigorous and it's religious in the organization. Now, we have hurdle rates that we establish, and I didn't mention here, but there is not a single one of the programs that we have provided appropriations for that has a return of more than 2.5 years, right? Now, that's not some of the sexier ones we're talking about that are further out. They're more skunk works in nature, but my point is that those stage gates force you to walk away from ideas that may sound very exciting if they don't meet those hurdle rates. And it's a painful, painful thing to do as an organization, right? But to maintain the robustness of the platform we have and to give us the opportunity to search for new things tomorrow, that's sacrosanct. That has to be protected, right? The other thing we do is we make an effort not to stray too far from our core, right? Again, we don't have the time today. We're taking one excursion into an area that, again, I can corral if it goes wonky on us. But in general, we stay, if you take a look at our genesis, industrial alcohol, the use of DDGs, et cetera, we've been doing that for 25 years. So we tend to look for things when the most undervalued portion of an existing corn processing facility to make ethanol or even especially alcohols is that dried distillers grains. There's a lot of waste in there as far as future value. So we know a little bit about this. We have nutritionists on board that have worked with us with the farming community. So we tend to drill down those things, stay within the comfort zone we have. Now, I understand. I mean, we're fortunate we have a large platform to work from. So the lesson may not be as valuable for somebody in the startup mode. Discipline, as silly as it sounds, is absolutely critical because you can find yourself way the hell out there in left field the next morning. And staying close to the things that you can get your arms around and recruit others who understand the value chain. the whole value chain you're trying to fit into. A comment was made about biodiesel. I remember working with biodiesel folks 10 years ago where feedstock's free, guys, free. Nothing's free. As soon as you start using it, you created a market, and there you go. All right, so it's understanding what will tend to happen in that case. In our case, we had a couple of others. The learning how to hedge commodities. I'm an engineer. I don't know anything about hedging, but it was pretty clear if we wanted a model to succeed, we had better get some good risk management capability on board. So taking the time to bring the right resources in to really own that value chain slows you down. But it's also probably in our minds the best assurance of success at the end of the game.
Do you see parallels, just real quick, and then we'll get on to you, Scott, but just while we're on it, you made a good case about your ability to move up the value chain, which could be something as simple as repackaging something and throwing some loops on it or whatever, and you get a lot more for it.
Certification.
Retail versus hotels, wholesale, certifications on. So there's that sort of I would call a very simple way of moving up the value chain. There's also clearly sort of a path to next-gen stuff that you're playing with, which we just talked. Do you see them in similar ways? Do you view an entry point into next-gen biofuels as a value chain issue, or do you view it as a feedstock supply issue? How do you view that? Are there parallels to how you move up the value chain on the product side?
There are parallels, but if we do the value chain on, let's say, the cellulosic piece, I think our sort of come to Jesus point for us was because we spent time working with Iogen and we saw what happened there, et cetera. And we looked at that and figured, what do we know how to do? The first thing that popped up for us was, as good as the technology was, and as available as the feedstock was, we were talking wheat straw, anything that grew would be, there was no delivery mechanism.
Right.
There was no way to get whatever that feedstock was in a commercially viable way to the technology. And that's still a big issue today in that industry. So what we did, rather than say, okay, we're going to beat everybody on enzyme generation and karyotyping of yeasts and all this sort of thing, I don't think so. We focused in on what we call pre-treatment. All right? So what do you need to do to make that delivery mechanism issue less of an issue? So for us getting into downstream into next gen, we picked a small niche in that chain
where you can add value to that niche as an operator.
As an operator, and then either sell the IP if you're successful, or sell the build out for that bolt-on skid if you're successful.
Yeah.
As far as taking existing products and moving them down the road, I think the most important message there and these are just lessons learned, we learned pretty quickly, if you want to be significant in the pharmaceutical industry or the life sciences industry worldwide, don't try and do it directly with the end user yourself. Because in most jurisdictions around the world, there is a specialized distributor that has relationships that have been in place for generations, for Asia, for example. So we learned very quickly that you don't try and go around that. You negotiate the margin split, and you go through that channel. Right? So there are different approaches. It takes different kinds of thinking, and that's why you need basically our head office consists of 5 of us, and it's a constant meeting. Literally, it sounds hokey, but every day. That's all we do. And I've moved the entire admin office, sales, et cetera, to another location because we can be a pain in the neck. But what we do is we worry that the discipline that we've put in place and the way we think about these things is intact. And that's about it.
Great. That's a great story. Scott.
I absolutely am going to use the podium. It's a crutch. I see that climate change kept one of our guests from arriving on time. It's all good. Ladies and gentlemen, thank you very much, and thanks to our hosts for having us here today. My name is Scott Thurlow. I'm the president of the Canadian Renewable Fuels Association, and I'm here to give you a little bit of a different story. I was asked to come here and talk very specifically about the challenges that our industry is facing and to talk about what those opportunities are and what we think the policy gaps are that can bridge the gap between the issues that we're facing and the development of what I will call the biorefinery or the bioeconomy. So on this chart here is all of the operating and under development biofuels plants in Canada. So we have approximately 37 plants that are at some stage of development. There is endless amount of bolt-ons to other industrial applications, like cement plants, for example, where they're creating their own bioenergy. But these are the biofuels plants. These are the plants that are going into the transportation fuel sector. We have approximately 1.8 billion liters of ethanol that's produced in Canada every year. Our mandate, what was referenced by Bob, is for approximately, based on how much gasoline we use, 2.1 billion liters of ethanol. But Canada imports an additional billion liters. We're over-complying, okay? And the reason that we're seeing this over-compliance, in most of Ontario, we're blending at about 9–10%, not 5. The mandate's 5, we're blending at 10. The reason for that is simple. First of all, ethanol is cheaper than gasoline. That's the most important point that I can share with you today. On the commodity-based market that Bob was talking about earlier, it is an incredibly cheap and incredibly clean way to get octane into gasoline. This is very, very important because, as I'm sure you know, the oil and gas companies are passing those savings on to you. But why do we have this over-compliance? Because ethanol, in addition to being a fuel, has a lot of other properties that make it very attractive to the oil and gas industry. So the mandate was what got them started, then they got using it, and they understood that this is a very valuable product and we should be using it. From my perspective, this is the most important chart that we have. This is the difference in GHG emissions from the fuels that we produce and the fuels that are on the roads today, okay? As you can see, on a life cycle basis, so that's from the very first instance that the seed is put in the ground till it comes out of the end of your tailpipe, our ethanols are significantly better than gasoline. Now, from a GHG perspective, the biodiesel story is an even better one, but what we need to understand here is that the key to the future profitability of this industry after the end of the operating incentives, and I'm happy to take questions about the operating incentives later, is how do we monetize the difference between the GHG emissions from the ethanol or biodiesel that's being produced in Canada and the petroleum product that it's replacing and or complementing. Now you'll notice at the far right, there's also Palm HDRD there. That has a bunch of different social problems associated with it, but from a GHG perspective, it's actually worse than highway diesel. So before I get into the challenges, I want to do just a little bit of myth busting. So this is the Canadian corn supply going back to almost when I was born. And what you can see from that is that we're producing significantly more corn today than we have in the last little while. And this is very important because I want you to keep this in mind as we go through the next couple slides. We're also not importing corn anymore. We're exporting corn. So 2006, that is when the federal mandate in the United States kicked off. Since the creation of the federal mandate in the United States, we've actually produced more corn. Now combine that last slide with this one. This is the amount of agricultural land in Canada that is being used right now. Crops, fallow, and pasture. You'll notice that that number has not changed, up or down, since 2006. We're making more corn on the same amount of land. Innovations that was stemmed from the creation of the ethanol industry. And this is the other thing that's very important to what I will call the food versus fuel misnomer. This is the meat that we eat in North America. Vegetarians, thank you for not eating meat. But as you can see, in the mid-70s, we ate a lot of beef, and that is curtailed. It's curtailed for a lot of reasons. Price is one, health choices are another, but you can see that we are now eating much more chicken. What does that mean? Well, if you look at the third line, on a feed to boneless meat perspective, it takes far less feed to get chicken up to weight than it does to get beef or to get pork up to weight. So we have more food, we're making it off of less land. Unless we have a biofuels industry, there's going to be some issues for the development of the value of that corn unless it has an industry to feed into. And that's incredibly important. So, what are the challenges to cellulosic? Well, you heard a lot of them kind of throughout Bob's talk today, okay? It's incredibly capital extensive. intensive rather. The pre-treatment costs are incredibly expensive. The members that I have that are playing in this space, their Rubicon to cross is how do we get the feedstock off the field, out of the forests, and into a production facility in a way that it can be turned into an ethanol and other co-products that can be sold, okay? And then there's the competition for investment. Now, I have always told people in previous presentations that the existence of the US RIN market is both a blessing and a curse. It's a blessing because there's always going to be draw for that cellulosic product. It's a curse because there's always going to be a draw for that cellulosic product. And as a result, the investment is going to gravitate towards the United States. So my question for policymakers, if we want to have a cellulosic industry in Canada, how do we keep that fuel here? How do we encourage investment here? There's a lot of ways. But most importantly, what is the cellulosic ethanol competing with? Unfortunately, in Canada, cellulosic ethanol is competing with corn-based ethanol. There's no incentive right now that differentiates between corn-based ethanol, cellulosic ethanol. That's a problem. Here are the points of entry for 2012 for all the corn-based ethanol that was coming into Canada from the United States. 485 million liters was coming through Detroit. That was coming into Ontario. It was coming into Ontario for over-compliance. That should be a market that cellulosic ethanol could displace. The problem is the cost chart. Now, I apologize, this cost chart is a couple months out of date, and it's a very important couple of months, let me tell you, because the price of corn has gone straight down, okay? And the price of ethanol hasn't really changed. Now, historically, you can see the blue line always right around $2, gets up to $3 sometimes, but the price of corn oscillates significantly more than that. Today, and I think yesterday, ethanol was $1.90 on the CBOT commodity exchange. Okay, corn is right around $4. Okay, so the point from this slide, when combined with the last slide, is that we're importing cheap ethanol, and we have to compete on a cellulosic basis with that cheap ethanol. And then this is the most dangerous slide. This is the one that I think drives the real bankers out to lunch when they're looking at investments in ethanol. We have so much ethanol in the United States, but because of fuel economy regulations that are going to be coming forward, we're going to be using less and less gasoline. If we use less gasoline, that means there's less ethanol that has to go into it. Now, there's one caveat to this. Automotive companies are going bonkers right now trying to figure out how they're going to meet their fuel economy standards. It's really important that they get up to 54 miles per gallon by the year 2025. Ford, General Motors, Mercedes, Honda, all of them are saying smaller engines, higher octane fuel. There is no cheaper or cleaner source of octane than ethanol. So they're talking about having blends of E20, E25, when right now we're at E10. That would solve that problem very quickly. So we are on the cusp of breaking out on the cellulosic space. We have waste, we have forestry residues, we have stover, we have other farm energy crops. Whoops, I'm getting way ahead of myself here. We have this wealth of feedstocks, but we've got to get it from the feedstock to a way that can be out into the ethanol economy. And that actually is incredibly expensive to do. So how do we bridge that gap? Number one, both the United States and Europe have very rigorous, very large, multi-billion-dollar bioeconomy strategies. We do not have one in Canada. We've been calling for one for 2 years. We have several federal departments staring at each other saying, well, you do it, I don't want to do it, okay? Secondly, we need a way to commercialize these cellulosic fuels. The Next Generation for Biofuel Funds is a fantastic fund, but nobody's taking advantage of it. Okay? We can talk about Iogen and what was dedicated to them under the NGBF, but it's just sitting there. We need to preserve that fund. We need to expand it to allow it to go into renewable chemicals as well as the renewable fuels that it was created for. And then this third thing is we have to start narrowing the difference between regular fuel ethanol, whether it's from corn or from wheat, and this new special cellulosic fuel. We think the first step to that is to exempt it from the road tax. It's a small difference. It's 10 cents a liter, but it's something that will show investors that there's an opportunity. Now, what are the long-term drivers? You heard it here first, ladies and gentlemen. We need to monetize carbon. I can assure you that this goes over really well in Ottawa. But the point, and this goes back to one of the first slides that I had, what's the biggest difference between our fuels and petroleum? The GHG difference. We need to find a way to monetize that difference, to make those investments more palatable for the people who are making those investments here in Canada. And then the last thing that we need, and this is more infrastructure, and I can't believe I'm lobbying for something that's going to help the oil and gas company even more, but they need capital to turn their pumps over. When you go to the gas station, that infrastructure costs a significant amount of money. They have no incentive right now to change their pumps to get ready for E20, E30, E85. And actually, E85 was a monumental failure in Canada because we have over 100,000 vehicles in Ontario, probably all stuck in the snow right now, that can take 85% ethanol. We have 11 pumps in the province. The oil and gas the automotive companies need to get that fuel into the vehicles so that the consumers can take advantage of the technology that the consumers are paying for. There is no point in adding the price of 5–10% to the cost of a General Motors vehicle if it's not going to have the fuel to reduce the GHGs. Now, plug. Next week, if you don't have plans, please come to the Renewable Fuels Summit in Montreal. This summit is going to be a collection of all the companies that are working on the innovation on this side. Biodiesel, ethanol, next gen, advanced fuels, advanced chemicals. This is where the innovators come and meet and share ideas. I really do hope that you can find the time to come and join us, and thank you very much for allowing me to speak here today.
Garry Rawson here from Elementa. So Garry, we're just going sort of one by one and giving our pitches, and I'll ask a few questions when sort of you've gone through your piece. So welcome to MaRS. Just real quick before you go, I just want to follow up on a couple of points here. Are you saying, and I think we agree, but at the end of the day, cellulosic ethanol is competing against corn ethanol.
Yes.
For a share of the market. At the end of the day, it's all going to be about the price you deliver that stuff to market, competing for feedstocks at scale, right? The other point I make is, so I think we agree on that, ultimately, at the end of the day, but there needs to be some mechanisms to get cellulosic stuff in play. And as I understand it, Next Gen Fund in Ottawa will be having some announcements very soon. So I think that fund is going up the door.
So I was happy to participate in an announcement just 2 months ago at the Varennes plant with Minister Oliver. It is the first announcement that was made under the NGBF.
Yeah.
So, I mean, and that was a fund that was created in 2007. So on your fingers, how many years has that been?
Yeah.
It's been a while.
Expect more soon. What I found interesting in your talk was this, we now have this, in the States, it's a public relations battle between the refiners, essentially, who own the gasoline and don't want to refit their pumps, talking about damage to engine at more than 10% ethanol. And I think you now have the OEM saying, well, if you want me to meet my fuel standards, I want more ethanol in the fuel. How's that going to play out? I mean, one normally thinks of these people on the same side of the fence. It's fossil fuels. But now we're seeing divisions within the fossil fuel sector, those who use it and those who produce it, on this particular issue. How's that going to play out?
So I usually have a slide that shows who all of my members are, but I only had 10 minutes, so I had to cut it out. It's important to remember that not all fossil fuel companies are the same. Suncor has the second largest ethanol plant in Canada. They own it in Sarnia, okay? They are partners, okay? We take a much more conciliatory approach in our association. Shell is one of our members. They have a joint venture with Biox, which is a biodiesel company. In the US, it's very antagonistic. The problem in the US is actually the life of cars. In Canada, because of our snow and salt, our cars don't last as long. But in the US, you do have cars today on the road that will have warranty issues, if they still are on warranty, with blends over 10%. Now, we can have a debate about whether or not that's a problem, okay? But there are a lot of misconceptions about how ethanol can be used. And so you will see companies like Ford and General Motors lobbying to see higher blends in place. And then I turn to the best jurisdiction in the world, Minnesota, where they have very, very high mandates, and they have the blender pumps. So a consumer with the right information can choose the fuel that they want. And in some cases, there's even a dial right on the pump. And as they turn the dial to more ethanol, the price goes down. And you just see them go, I'm saving money, I'm saving money, I'm saving money, I'm saving the planet, I'm saving money. Okay, it's a fantastic concept. Not so much in Canada yet. We'd like to see that.
So when we have bio-based materials in our cars, we'll see less rusting, and maybe we'll have sort of leaving that out at the end. Thanks, Scott. That was really helpful. Gary, why don't you take center stage?
Thank you. And climate change is alive and well in Niagara. We got a lot of snow last night. Quite a shock this morning. My name is Garry Rawson. I'm VP of Finance and Corporate Developments of Elementa Group Inc. We are a company located in Niagara, Niagara on the Lake, actually. And our focus is our company is a technology company. And since our inception, 10 years ago as a company, in terms of the technology, 15 years ago, our focus has been around perfecting the technology. So we are not a capital raising machine, we're not a promoting machine, we are a technology company, and we work with a very nasty feed source, which is not MSW, it's garbage. So we work with garbage. And we have finished our bench scale, we finished our pilot plant facility, we are now at the stage of the commercial demonstration plant. It's going to be in Sault Ste. Marie. It'll process 50,000 tons of garbage a year, which is enough for a city of about 50,000 people, and it'll produce about 10 megawatts of power to the grid. There we go. I'm sure you've all seen the picture of the polar bear there. And yes, climate change is upon us. I don't think anybody would disagree with that. I find it interesting, the quote from Branson around a money-making opportunity as a result of that. Unfortunately, we think we've found the holy grail, which is to solve climate change without incremental cost to the consumer. I don't think anybody in this world would say they don't want to improve the environment. I'm sure if I asked for a show of hands to say who's not an environmentalist, probably nobody would put their hand up. But does anybody want to pay for it? No. So I want to be an environmentalist, but I don't want to pay for it. So we knew as we were developing the technology, we had to develop a technology that would solve the landfill problem and provide power at grid rate power. So we can compete with the coal, the nuclear, and the hydro. And I'll show you that in a few minutes. So this is our buddy Albert Einstein. So I'd just like you to remember this quote about how stupid we as humans are. So here's a nice picture of a landfill. And this is in Central America, Guatemala City, taken not too many years ago, 2011, I believe. I'm a Mayan history aficionado, so I really appreciate the fact that the Mayans threw out their garbage because it told us a lot about what was going on in the Mayan culture 2,000 years ago. And from the looks of that, we aren't much better, I would say, 2,000 years later. Just a couple of other examples. I'm going to talk about this in a second, but in India, they throw raw bio waste from hospitals into the landfill. And people sort through that landfill to make a living. In this instance here in Guatemala City, that's a river that flows out of a landfill that's 1,000 feet above where those people are. And when it floods and they get the rains and it collapses, people die from that. Scores of people die, but that's how these people make their living. Unfortunately, the landfills, in people's mind, it's not my problem. As soon as we all put our garbage out on the corner, whatever day of the week it is, and you put your recycle material in the recycle bin, it's kind of out of our mind. Yes, we're aware landfills are a nasty thing, but it really isn't a problem in our backyard. But it really is. It really is. And remember, going back to what Einstein, people are stupid. We throw out garbage, and the problem in Guatemala or India or wherever else you want to pick in this world, one of the biggest emitters of methane gas in the world is landfills. And methane is arguably a far worse greenhouse gas than carbon dioxide. So here's a bag of garbage. So it's an asset or liability, like they say in Globe and Mail. Perspective is everything. To us, it's an asset. Most people, the unpleasantness of, in my case, Thursday morning, when it's over, I'm finished with it. So here we are. This is a slide of a dump truck going to the landfill. And below that is, those people that are engineers and chemists would know this. The formulas there are for methane gas and carbon dioxide. So which one's worse? Below that, you'll see GWP 2579 and GWP 1. The GWP stands for global warming potential. And it's all compared to carbon dioxide. So all the other greenhouse gases, of which there is a multitude, the two biggest ones are carbon dioxide and methane, are all compared to carbon dioxide. So carbon dioxide's got a global warming potential of 1. Methane has got a global potential of 25 if you measure it on a 100-year scale, like they do with CO2. If you measure it on a 20-year scale, it's 79 times worse than carbon dioxide. So if you look over at the chart on the right, you'll see this is the sources of man-made methane. And the biggest one is natural gas petroleum systems. And what that is fracking, pipeline, storage of gas, leaks. Natural gas is basically methane, so that evaporates into the atmosphere. The second biggest one is livestock, which we really can't do anything about, but the third one you can see is landfills. So there's a great move afoot to reduce the amount of carbon dioxide, which basically means eliminating as much as we can. We've had other people talk about it, carbon dioxide. So that's cars and coal plants. Okay, so if we're going to eliminate those two, where are we going to get electricity from? And I'll show you that in a second. But hydrogen. So we don't want to use gasoline in cars. So we're going to replace it with fuel cell cars and electric cars. So fuel cells run on hydrogen. Hydrogen comes from natural gas. So all we're doing is exacerbating the amount of methane that's going into the atmosphere using petroleum-based products. Electricity, of course, and I see my colleague here from OPA is in the audience. And this is a worldwide chart, but you'll see that electricity largely comes from coal and natural gas. Those are the two biggest pieces. So what have we done? We've shifted one problem to another problem. And in fact, over the past number of years, carbon dioxide emissions into the atmosphere have reduced. But guess what's gone up? Methane's gone up. So at the end of the day, we're in the same place. So here we are playing this game of, shell game of just moving things around, but we really are not solving the problem. We think at Elementa, we can deal with that one piece, which is landfill. Eliminating landfill, and really there's no cost to the infrastructure. So we don't need to change anything. Our value proposition to cities is instead of your dump truck going to a landfill, take it to one of our plants. We as consumers would see no difference. We recycle as we always do, throw our garbage bag onto the street, nothing is different. So what we've eliminated, what would go to the landfill. Now, I'm sure the landfill people won't be very happy about that, but at the end of the day, I think it's better for the climate. So here on this slide is the environmental agencies are effectively banning landfills. So here you can see on the slide here with, in the US, look at the decrease in the number of landfills in operation, albeit they're getting bigger, but there's fewer of them. And Ontario, we haven't had a new landfill permitted in 10 years. So what's going to happen? Well, we recycle and we divert. And I don't know about you, but when I recycle my can of yogurt and put it into or plastic container of yogurt and put it in the recycle, I wonder where that goes. Recycling, but where does that end up? And I don't really know. We divert. So we divert to other uses of that, our waste, our garbage, and who really knows where it ends up? Got a lot of suspicions, but I'm pretty confident that yogurt container I send out doesn't end up with more yogurt in it in the grocery store next week. And in spite of all our efforts, garbage is increasing. There's more garbage going to the landfill all the time, and we cannot seem to fix it. So here's our solution. And it's pretty simple. And going back to what we said, we focused on technology, we focused on making it simple. So we take that bag of garbage, we add water where we need to. Our technology is there's no incineration, there's no burning, or using that other word that you hear, oxidation. We don't use any oxidation, so it's an oxygen-starved environment, which means we get a high-value syngas. We got a lot of syngas. We run it in an engine, and we make electricity. That electricity meets all the standards here in Ontario. And in fact, to get to the electricity, we go through a syngas first. And that syngas, in a lot of ways, is similar to natural gas. So whatever you use natural gas for, you can use syngas for. So we can make a lot of products that have been talked about here today. Here's another chart that shows the, what happens to waste. And pre-Elementa, that's what happens. This is kind of an average in North America. The one on the right is what happens after Elementa. And what I find curious about this particular chart is the dispose at the bottom on the Elementa part is a very small number. And in that dispose is, through our process, we pull out all the nasty heavy metals, so leads and mercuries and cadmiums, all that comes out, and it gets dealt with correctly as hazardous waste. When you look at the chart on the left, that same garbage produces those same nasty metals, and it ends up sitting in the bottom of a landfill. So unless you're an unfortunate soul who happens to live at the base of a landfill, which people in St. Catharines unfortunately do, on the escarpment is a landfill, and below that there's some nice houses, and you see this stuff seep out of the ground, and that's what it is. It's pretty nasty stuff. But it does end up in our groundwater. So we would say that we're doing a better job with the garbage than we currently do. And just to highlight the point, this is what we do not do in our technology. There's no burning, there's no incineration, there's no oxidation, there is none of that nasty stuff. And at the end of the day, here's how our economics compared. The one on the left is basically the homes powered per $1 million of CapEx. And you can see that we significantly outperform our competitor technologies. And on the right is the North American levelized cost of electricity per kilowatt. Now this is when we get to scale, so it'll be a 300,000 ton plant making 74 megawatts compared to coal, nuclear, and hydro, and this is new generation power. This assumes that we would amortize our capital cost over 40 years like coal does. Nuclear is 60 years, and I think hydro is 80 years. But even in hydro, they alter that to get the cost down. So it's kind of a neat calculation that occurs. So you can see we're going to get rid of landfills, and we're going to produce it at grid rate once we get to scale. So what's the problem? Sounds like we have reached the holy grail, but the problems are we got the stigma of waste energy means incineration. So we spend a lot of time talking to people about we're not incinerators. Another issue is garbage is not a direct consumer issue. Again, when we put it out on the curb, it's kind of out of our mind. There's been a lot of over-promotion in the bioenergy industry. And I'm particularly making reference here to the US. There was a lot of IPOs done in the 2010-2011 period, a lot of expectations, and they didn't pan out, so the investment community in the States has not got a lot of interest in bioenergy at this time. The lack of visionary thinking or resistance to change, we run into this all the time. And it's amazing, we find it amazing that when you're talking to people at a very high level and say, well, surely we can find a better way to deal with garbage, and people are so entrenched in their ways of thinking that they don't want to do that. They don't want to change what the process has been for, going back to the Mayans, 2,000 years. And there's a disconnect between the environmental and power policies. The environmental, getting rid of landfills. On the power side, which we all appreciate and understand, is buy power at the cheapest rate possible. We find there's a great government reluctance to meaningful support innovation in this country. And there's such an overbearing bureaucratic regulatory regime. I've been told that in, I think it was probably 20 or 30 years ago when the Pickering nuclear plant was built, the environmental assessment was 1,400 pages long. A windmill farm in Niagara for 10 megawatts is 1,400 pages. So, and I don't know what more value we get for that kind of regulation. So our learnings, and some of them are pretty obvious, is it always takes longer. You always need more money. And, but we think we've done the right thing of focusing on the technology. So we have got the technology right. And we are very critical about ourselves internally about what's really different. So there are other technologies that will get rid of garbage as well. There's other technologies that can produce power cheaply. So what makes us so different? So you really have to be critical about that. And the last one I would say is resist the temptation to over-promote. I heard it earlier. You got to get to you got to go through the stages, and we agree 100%. And unfortunately, in our industry, in our case, we're feeling the effect of some of our competitors not doing that. Anyways, good.
Thanks very much.
Okay.
Thanks very much, Gary. So I think on that note, we will go to the audience for some questions. So if you do have one, line it up in your mind. There's a microphone there and a microphone there. But just before we do, there was a theme that ran throughout this panel around partnerships. And what's interesting is we have, from one end of the spectrum, we have electrical production, which is a very basic commodity. We have an investor who's got a bunch of ag stuff, so that's a very broad perspective. I take the same approach. And we have a very big entrenched player who has multiple outputs, playing with the inputs, and we have a fuels association, which represents many people. So partnerships is something that we all deal with. And what I want to ask a question around is partnerships with incumbents in particular, because whether it's regulatory, whether it's an argument about how much ethanol we have in our fuel standards, whether it's the VCs exiting the space, and so we need to find new capital from people who've got a balance sheet, which is the incumbents. How is it that we might approach partnerships with the incumbents in a way that allows this innovation to get into the space a little less threatening? I gave a talk at a Calgary World Petroleum Conference a couple weeks ago, and part of the discussion was around lack of capital and this resistance to ethanol mandates, or even greenhouse gases being priced. And my point was, well, and I said it to the room. I said, well, if you owned a piece of the next generation of innovation, I don't think you'd be so resistant. And you've got the capital, you've got the engineering, you've got the global market access, you've got the lobbying clout. How is it that we talk to the incumbent? How might we change the conversation so that the incumbents would be a little more welcoming to innovation and being part of the solution? I know it's a very broad question, but I think that's a critical one for the bio industry, right? As it goes through its growing pains of needing policy, of needing training wheels on the bikes, and getting into the place where we don't need those supports because we've scaled and we have a market that we can address. How do we engage with the incumbents? Anybody can take this one.
Let me go first.
Yeah, sure.
And I'll set the stage, because I think what they say in public and the lobbying that they do is very different than the business decisions that they make. I reference Suncor. Suncor is just one. Husky owns 2 ethanol facilities, one in Manitoba, one in Saskatchewan. Valero owns 11 plants in the United States. At the same time, they're the strongest lobbyists against the renewable fuel standard in the United States. So I think they are already there in terms of making those investments, but it's a little bit of a difference between what they're telling their bankers and what they're telling the newspapers or the decision makers in Washington. And I mean, my sense, having spoken to the petroleum guys quite a bit, is that if there is a technology that they think will give them an advantage at the pump, they will be all over it. If they can find a way to get to that price differential, to First of all, give them a marketing advantage. I mean, Shell is a very good example about how they marketed the cellulosic ethanol that they had been blending from 2008 to 2012. This is something that is going to help their bottom line. So I think you're right on the nose.
So corn ethanol was originally an octane enhancer, right? It was never meant to be at the beginning a greenhouse gas abatement issue. So why didn't the incumbents engage on being part of Greenfield and playing in that space when it was a core commodity additive to an existing product that had nothing to do with the scary issue of climate change? Was it simply, I'm just going to have somebody else who knows what they do supply it to me, and I view it as a small additive? Why weren't they engaged? Maybe you have some answers to this, Bob.
Right, and they're not necessarily objective because I'm on the side of.
You don't have to be objective.
Good, all right. I think part of it has to do, you're calling them the incumbents. In other words, let's say the oil industry has had 100% market share for 100 years. And regardless of how attractive this alternative is, all right, somebody's taking away 5 to 10% of that. I'll be damned if I'm going to let that happen. I think that the early days, that was the mentality. I think Scott's right. Then you have those with a little bit more foresight, like the Suncors and the Valeros, coming into the space, playing in it, trying to figure it out. And frankly, I mean, the measure of success of the whole concept is if we disappear. In other words, if, as a private company, if a Suncor were to come to us and say, you know what, you guys have traction, you do the sort of thing that we believe, the transportation fuel industry is going into, let's talk about integrating. Then the story's right. But I think some of it was that. We still sense it with individuals. But let me come back to something you said about, because when you were talking about incumbents, I was thinking, as I said, we're sort of an established, reasonably successful
Are you an incumbent now?
We're an intermediate incumbent. In other words, one of the things that we've found as far as attracting innovation.
Is that the same as boring innovator?
Same thing. About the same payout, too. But what we found is the more well-developed technology champions, if you like, or candidates, meet with us and look at us from a perspective of what we can bring to the table. In other words, anybody today who thinks that they're going to be successful in building a grassroots facility with all its support in location X, I think is taking on more than they have to. I mean, we truly believe in the biorefinery concept. We have the footprint. It's established. So someone who's got a good technology, as you know, the technology often is just this much of the whole piece that's necessary. They need utilities. They need engineering capability. They need an established market provider. And we're finding that those that we talk, because we talk to these folks all the time, that know how to value that and can figure out how to basically work out a joint venture with someone who already has an established platform, they're the ones that really have a better shot at success, because they don't have to worry about, okay, my technology was supposed to be $40 million, and I really have drilled down, I've got project grade estimates on all of that, but oops, boy, I need steam, I need it at this pressure, my power requirements are more than I thought they were. You start building those into your capital costs, and you just go bust.
Higher AMIC early, higher AMIC often.
Got it. Exactly.
So if I just add one thing, I mean, I think it's also know what you do and pick the best strategic partner. Enerchem, I think, is a great example, not only because they're partnering with Bob at Varennes, but they're partnering with Waste Management in Edmonton. So they're seizing on the problem that was discussed earlier about the waste to landfill issue, but there's also an end game of creating a cellulosic ethanol or methanol in the case of Edmonton for its first year of production. So that is the best partnership imaginable. It's negative cost feedstock. Waste Management is paying Enerchem to take the waste.
Andy, what do you think? Partnerships was a big part of your piece. I mean,
Yeah.
anything to add to that? The big bad incumbents. What do we?
Well,
friend, foe. What are they?
I have limited experience, but the one, I guess, major incumbent that we do have some relationship with is Chevron, and they seem to have been. I mean, I think these guys would know much more than I, but my impression is that the EPA standards in the U.S. is putting pressure on refineries to have cellulosic ethanol in their pipeline, and they're moving to try to accommodate that. That's a business necessity, and it seems to be motivating change. And so I think public policy drivers are probably part of the mix of what makes incumbents want to be part of this. And then there's sort of general enlightenment for those companies that can look at far enough. I think they see that that this is going to be part of their business, so they may as well engage now. But our experience has been a good one, although I have to admit quite limited. You know, I don't know if it represents the broader ecosystem, or if it's just a sort of one instance where it seems to have worked reasonably well.
I'm painting with a very broad brush here, so it's not fair to sort of perhaps do that. Garry, what are your approaches to incumbents, and who are your incumbents?
Well, we've got partnerships with fairly obvious ones, the suppliers of the equipment, Caterpillar Finance for the financial side, equity players, other suppliers. But what we find interesting is partnerships are developing with consumer companies. And consumer companies have figured out, because that's what they do very well, the monetized value of being able to say that they can reduce greenhouse gas emissions by the products they sell, their processes, the suppliers they deal with, et cetera. So what we're finding is the likes of Walmart and Procter & Gamble, for instance, is while we don't want to pay a premium to be able to say our waste is processed through your system, we certainly want to be associated with you because we want to be able to say none of our waste goes to a landfill. So we got our company is that much greener, and just about every major company in this world has got significant reduction of waste or greenhouse gas reduction targets, and they struggle to meet those. And we find interesting that is a developing partnership that has got some interesting potential for us.
Great. Why don't we go to the audience? There must be some questions here. There's 2 microphones there and there. Please don't be shy. Yeah, just introduce yourself briefly and then...
Sure. So my name's Grant Allen. I'm a professor and chair in the Department of Chemical Engineering and Applied Chemistry just down the street. I know some of the folks in the companies up here. Actually really glad, Bob, that you talked about scale-up. It was the topic of my second-year lecture yesterday, no kidding, in fluid mechanics, and the importance of what we learn at scale, that everything isn't the same at the bench and the higher scale. I guess my question is, so we've been talking a lot about fuels, but I think in this session it was also about other types of chemicals. So one of the things I'm seeing in people say that are talking even about algae or other types of product is not making fuel, but making something that's higher up the value chain, even like a platform chemical that could then go and feed into the petrochemicals industry and make polymers and things like that. So is there anybody able to sort of talk about that opportunity rather than just making something that's going to use as a fuel? Or maybe there are things we can use ethanol for that also fit into that value chain.
Yeah, I'll take a shot at it because we're involved in some of those. I mean, that's every participant's dream as far as I'm concerned. Again, we were fortunate coming from the industrial alcohol platform into fuel ethanol. We already had a feel for there have to be other things you can do with this molecule. It's been around for so long. I mean, we make beverage alcohol as well, which isn't a bad place to be, by the way. But the point is, at the same time as we were making some of these very basic industrial alcohols, we were also providing a company in Michigan, I won't name the company, that specializes in putting together something called TEOS, tetraethyl orthosilicate, which is basically, it looks like water, but it's 30% silicate metal. And the remainder is a very high purity alcohol that we ship to them under nitrogen blanket in rail cars. So that goes into actually producing angstrom thick layers of silicate metal used in producing IC circuits, integrated circuits. Right? So here you go, there's this tired old molecule that finds an opportunity like that, very high margin business as well. So we had a comfort already with the concept. Right? The ability to take this now and use it as building block molecules, as you'd mentioned, or platforms for bio-based polymers, I think is real. It's still somewhat early days. There's a lot of really interesting technology developing worldwide on this. My argument is they all need a platform to work from. We're working with an Israeli company now on this potential for corn oil into esters, whether they're butyl esters, ethyl esters, even methyl ester biodiesel. Literally, they're working out of 2 containers in Israel. Right? They've got a fantastic technology. We've tested it at the pre-pilot scale, and we're satisfied with it. What we have to offer them now is pick one of our plants. You've got all the utilities you need that are necessary. We have enough market access to determine whether it makes sense or not. We've got the build-out engineering capability, not the basic science, that's yours. And let's work a joint venture. So we found that there's a lot of interest there. I can't stress enough, you said it, I've said it, and I learned this from someone by the name of Frank Dettori, who used to be the CEO of Tembec. And the problem with not doing the scale-ups is that there are things that will not appear at a small scale that will absolutely kill your process at a higher scale. And the saying that he kept using that I really enjoyed was that, if you own a warehouse, and if the bananas out don't equal the bananas in, you've got a monkey in your warehouse. and that's a fact. I mean, we've learned that even at the pre-demo level. Things that were insignificant ended up creating a glassy coating on all our process equipment. Now picture doing that when you've just committed $300 million for a full-scale plant. It's dumb. You just don't do that. The problem with the staging, we're back to the boring innovation. It's slow, it's long, it's frustrating, and you possibly are seeing other guys go by, to the market first. But in a lot of cases, the ones that went by, you're just going to see them coming back the other way. And if you can learn from their mistakes and you've bothered to invest the time necessary to make this thing actually a commercial success, then that should be the story.
So if I could very quickly add, there are two very significant bioclusters that we're associated with. One's in Sarnia, one's in Drayton Valley. And they have the same problem that cellulosic ethanol has, in that cellulosic ethanol is competing with corn ethanol, and it's a price differential. The renewable chemical space, the renewable product space, whether it's butanol versus biobutanol, you have to make that biobutanol price competitive with ordinary butanol. It's a huge commercialization challenge. All the more reason why we should monetize the carbon difference between the two products to create the premium on the sustainable product.
So I also point out that, we're talking about differences in the value of an output from a process. Whether you make nutrients from the algae instead of fuel because that's your low-hanging fruit in terms of margin. I'd also argue that you can move your process to somewhere where the output is valued more. So in Elementa's case, for example, it's electricity. Ontario, we don't pay much, but in the Caribbean, you displace diesel generation. So I would argue there's a geographical difference in the value of your output for some of these bios, especially when it comes to sort of the the thermal, the heat, the electricity kind of stuff as well. So geography matters.
It does.
We have another question right over here. And then we're going to wrap up. We have this room, by the way, until 10. So do network, eat some muffins or fruit or whatever's at the back there, have a coffee, hang out. We do have another half an hour, but we'll take this as our last question, and then I'll just maybe have some quick closing remarks from the panel. Go ahead, sir.
Thank you. Don McCabe, Vice President of the Ontario Federation of Agriculture, and I'm also Vice Chair of the Bioindustrial Innovation Center, or we're now Bioindustrial Innovation Canada, actually working on those clusters that Mr. Thurlow just referred to. I also have to agree with the last two comments you made, Mr. Rand. Everybody please eat, because I'm a farmer, and I really like feeding deficit markets. The other side of the coin is geography does matter, and I can't move the farm. The reality is that I want to make a couple statements here around the issue of feedstocks. Number one, I think is best covered off by George Bernard Shaw. The biggest illusion with communication is that we actually think it happened. And the reality is, don't come to me looking for cellulosic ethanol feedstocks in the form of wheat or corn if you didn't want to buy the wheat and the corn in the first place. So if you actually think I've got cheap feedstock, it might be that your technology is not ready for prime time. And therefore, it's the issue of let's work further. There is not a delivery mechanism problem out there yet, in my opinion, because we can move wheat straw in a dang fast hurry, either to a mushroom plant or hay right straight to Saudi Arabia or to Florida. The reality is you haven't actually told us you want it yet. And the other side of the coin is maybe you're just not willing to pay enough for it either. And therefore that means we got to get in a room and sort this out, because maybe I want too much. And that means let's go look at some cooperative structures to make some of this happen. Because research is bringing the corn and everything else to the greater and greater yields, and we have a residue management issue that's starting to occur on some farms where we're not going to be able to plant the next spring properly with the amount of material that's there. Do not see that as dollar signs in your eyes that you're going to get something for free. I don't have any free feedstock. I've only got underutilized, undervalued opportunity. So I think the biggest issue here is let's talk. I've been in consultation with all 3 companies who are working in Iowa right now, or 2 in Iowa and 1 in Kansas, to bring cellulosic ethanol to the fore. And I'm fairly certain DuPont doesn't go to the vault unless it's going to bring back at least 15% return on investment. So I'm not necessarily going to sell you by the ton. I want to sell you by my return on investment with your return on investment. The corn market is very well established. It's running very, very well. I appreciate Mr. Thurlow's comments on the issue of food versus fuel and the other areas because they're all myth busting. But at the end of the day, if we're going to have a true value chain here, we got to make sure the weak link does not break or is rewelded or even established back to the farm community, because I can't move my geography. But I'm ready to play if you are.
No, I think it's a very good point. I would love to have my favorite horse, which is woodland biofuels, in the game enough to have a conversation. But we need to raise $100 million of equity before we can build the first plant and engage in legitimate long-term conversations about intake and offtake agreements. But to be fair, that's part of what Woodland does when they're looking at a commercial site, is they lock down 20-year feedstock supplies and 20-year offtake agreements. So that's part of what Woodland is doing now, and I think for sure that's a conversation we'd love to have. That's a mature industry dealing with its suppliers. So I hope to be in that position at some point, but we need to raise the capital first. Okay, thanks very much, everybody. Maybe if we have one last piece of wisdom, that's a tough thing, one last piece of wisdom. Say something wise, would you? And then we'll go have some coffee.
I agree with everything Don McCabe said. And I mean, he's absolutely correct in that we're still at that transition phase to how do we get the feedstock into our facility in a way that rewards both the farmers and the processors and makes it possible for them to generate wealth. That's why the pre-treatment work that Greenfield is doing is so important. That's why the different types of research that's being done on switchgrass or miscanthus or all these other potential crops. And the other issue, and I mean, I heard Don say this about a year ago, is that we also have a nutrient issue. I mean, if we're going to be taking a lot of this stuff off of the land, we have to find a way to, in an environmentally sustainable way, get the plant nutrients back into the soil so that we can have a sustainable crop that goes on forever. So I think it's more of a matter of when, and it's a matter of getting from what I'll call $5 a liter for cellulosic ethanol back down into the $1.05, $1.10 range.
Well, Woodland's $1 a gallon, but anyway, say something wise, Bob.
All right. Actually, the last comment I agree with. Unfortunately, it's just a question of patience. If you really believe that the end game is the right game, I don't care if you're using a greenhouse gas reduction concept, another environmental argument, et cetera, or just where you expect your children and your children's children's fuel needs to be met. If you really believe that makes sense, then you need the discipline to take the time to get there properly, because there's been so much damage done, and not just in our industry, by those who went to market too soon, gave it a black eye, and forcing the whole industry to retrench. So it's easy to say this as a private company, but patient money is really critical in something like this, because it buys you the time to go through a process that has high reliability. And it's easy to say, and we're fortunate that we're already sort of on that road, but we have found it to be probably the most critical thing in our entire business base. It's just the patience to do it right.
Thanks, Bob. Andy?
Just would strike me that Canada does have an interesting opportunity in cellulosic ethanol, cellulosic fuels companies. And the one comment that sort of struck me was Scott's, that there should be some policy driver to sort of encourage that. And I do that idea of reduction in the tax on cellulosic fuels, I think, is an interesting one. But I think it would behoove us to encourage those, those kinds of things, because I think there's an opportunity here that Canada has, and we have a number of interesting companies that seem to be moving forward in this space that could be, very exciting in the next couple of years. So, Gary.
Yeah, I guess my observation would be there's unlimited energy in this world, and I guess from our point of view, we just encourage us to force ourselves to use it in the most beneficial way, and that's from one end. So the levelized cost of electricity is an interesting concept, because you take it from when you first start it to when you decommission it, and that's the total cost, as opposed to taking a little piece in between. And surely we're smart enough to be able to figure out how to do that and not damage ourselves.
So my parting words of wisdom is read Linda O'Malley's report. It's good. It's worth downloading and paying some attention to. I think it's being released tomorrow. Is that today? Okay, good. So watch the MaRS site for that report. It's a good one. And I'd like you to join me in thanking our panel, who've very graciously given us their time and their wisdom today. Thanks very much, guys. I really appreciate that.
Thank you.